Why are my personal loan interest rates so high? Imagine trying to buy something important like a new car or paying 4 unexpected medical bills. You might turn to a personal loan, but then notice the interest rates are quite steep. Why does that happen? Well, several factors come into play that can make your interest rates higher than you expected. First, your credit score is a big deal. If your credit score is low, it shows lenders you're a higher risk. They see a greater chance you might not pay back the loan on time. To protect themselves, they charge higher interest rates. If your credit score is above 700, you usually qualify for lower rates. But if it's below 600, expect to pay more. Next, your debt-to-income ratio is important. This ratio compares how much you owe each month to how much money you make. If your debt-to-income ratio is high, it suggests you might struggle to handle more debt. Lenders see this as a risk and often increase your interest rate or refuse the loan altogether. Keeping your debt-to-income ratio below 35% can help you get better rates. The size of the loan and how long you plan to pay it back also matter. Larger loans or longer repayment periods mean more risk for the lender. For example, borrowing $20,000 over 5 years might have a higher interest rate than a smaller amount over 2 years. Shorter terms usually have lower rates but mean higher monthly payments. Lenders also look at your employment and income stability. If you have a steady job with reliable income, lenders feel more confident you can pay back. But if your job history is unstable or your income fluctuates, expect to pay higher interest rates. They want to protect themselves if you might miss payments. The type of loan makes a difference too. Unsecured personal loans, which don't require collateral like your house or car, tend to have higher interest rates. This is because if you don't pay, the lender has no collateral to recover their money. Secured loans usually have lower rates since they are backed by something of value. Economic conditions also influence interest rates. When the Federal Reserve raises the federal funds rate, borrowing costs for lenders go up. They often pass these costs onto borrowers through higher personal loan interest rates. Currently, economic factors have kept rates elevated, making borrowing more expensive. Different lenders set their rates based on their own risk models. Some may offer lower rates to borrowers with excellent credit and low debt-to-income ratios. Others might have higher rates if they see more risk in your profile. Shopping around can sometimes help you find a better deal. From a personal financial planning perspective, high interest rates can make managing your debt harder. They increase your monthly payments and reduce the money you have left for saving or investing. Improving your credit score, paying down existing debt, and choosing shorter loan terms can help lower your interest rates. This frees up more money for your investment plans. In short, your interest rates are high mainly because of your credit score, how much you owe compared to your income, the loan details, and current economic conditions. Knowing these factors helps you take steps to improve your financial profile. That way, you can qualify for lower rates and better manage your personal debt while working toward your investment goals.